Let's be real for a second. Who doesn't love the idea of getting paid just for owning a stock? You wake up, grab your phone, and boom, Coca-Cola just dropped $15 into your brokerage account. No extra work, no selling, it just shows up. Feels good, right? But then there's the other group, the so-called boring investors, the ones who say, stop overcomplicating it, just buy the entire market, sit still, wait 30 years. That's it. That's their whole strategy. So which one is actually better for building long-term wealth? Today, we're comparing dividend investing versus index funds. Not just returns, but psychology, retirement reality, and what each one feels like over time. And welcome back to Build a Millionaire. Subscribe now. Let's get into it.
First, what does it mean when a company pays a dividend? When you buy a stock, you become a part owner. A tiny part, sure, but still an owner. And some companies, usually big, established ones, make so much profit that they can't reinvest it all back into the business efficiently. So instead, they hand some of it back to you. That's a dividend. Real cash, deposited straight into your account. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. These companies have paid dividends for decades. Some have increased their dividend every single year for over 25 years. Those are called dividend aristocrats. The number you'll hear most often is dividend yield. Stock at 100 pays $10 per year, that's a 10% yield. Simple. But here's where it gets interesting. You don't have to pick individual stocks. You can buy a dividend ETF, a basket of dividend-paying companies that pays you regular income. So instead of relying on one company, you get dividends from dozens, sometimes hundreds at once.
So what's great about dividend investing? Advantage number one, income without selling shares. In retirement, you're not forced to sell anything. You live off the cash your portfolio generates. That's huge, especially during a market downturn. Your portfolio might be down on paper, but if dividends keep coming, you stay calm. Advantage number two, psychological stability. Seeing cash arrive every month or quarter helps people stay invested and avoid panic selling. Advantage number three, dividend growth. Strong companies increase their dividends over time. Inflation rises, your income can rise too. But there are real downsides. Downside number one, concentration risk. Dividend portfolios end up heavy in utilities, consumer staples, financials, real estate. You miss out on high growth areas like tech. Downside number two, dividends aren't free money. When a company pays a dividend, the stock price drops by roughly the same amount. You're not gaining extra value. You're just getting your own money back in cash. Downside number three, taxes. Dividends are taxed when you receive them, even if you reinvest. That slows down compounding. Downside number four, chasing high yields. Yields of 7%, 8%, 9% look tempting, but often that yield reflects underlying risk. Chasing high yields is a fast way to lose money.
Now, let's talk about the other side, index funds. An index fund tracks a market index, like the S&P 500, the 500 largest US companies. When you buy one fund, you instantly own a small piece of all those companies, automatic diversification. This philosophy was popularized by John Bogle, founder of Vanguard, back in the 1970s. His idea? Most professional fund managers fail to beat the market over time. So instead of trying to pick winners, just own the whole market. And decades of data have strongly supported it. So what's great about index funds? Advantage number one, diversification. One stock's bad performance barely matters. And you can go global, not just US. Advantage number two, low costs. Some index funds charge as little as 0.03% per year. Active funds often charge 1%. That difference compounds into hundreds of thousands over a lifetime. Advantage number three, tax efficiency. Index funds trade infrequently, so fewer taxable events. Your money compounds faster. Advantage number four, strong historical returns. S&P 500 has averaged roughly 8 to 9% annually over long periods.
No guarantees, but the track record is solid. But there are downsides too. Downside number 1, no built-in income stream. In retirement, you have to sell shares to fund your lifestyle. Selling during a market downturn? That feels terrible. Downside number 2, sequence of returns risk. If you retire right before a major crash and keep selling shares to pay bills, you lock in losses at the worst possible time. Downside number 3, it's boring. And being boring makes it hard to stay disciplined. When markets drop, there's no dividend income to reassure you, just red numbers on a screen. That's when people panic sell.
Let's make this real. Say you want to retire with $50,000 a year in income. Ignore taxes for simplicity. Dividend path. At a 3.5% yield, realistic for quality dividend stocks, you need roughly $1.43 million invested. Your income arrives automatically. Bad market year? Dividends usually keep coming. But your portfolio is less diversified, and over 30 years, you might leave serious growth on the table. Index fund path, 4% rule. The 4% rule says you can safely withdraw 4% of your portfolio per year with low risk of running out over 30 years. To get $50,000 per year, you need $1.25 million. Actually less than the dividend path. Your portfolio grows faster because you're in the whole market. But you have to sell shares, and if the market crashes early in retirement, that's brutal.
So what actually works best? Honestly, it comes down to the strategy you can stick with over the long term. But if I had to choose, purely based on the numbers, index funds come out ahead. Lower costs, broader diversification, and historically stronger total returns. That's what the data shows. But dividend investing wins on the psychological side. The cash flow helps people stay calm and avoid stupid mistakes. Here's the truth most YouTubers won't tell you. The biggest mistakes don't come from choosing dividends or index funds. They come from behavior, panic selling during downturns, chasing high yields in risky companies, or never investing at all because you're stuck trying to find the perfect strategy. If you found this helpful, hit that like button. It really helps the channel. And comment below, do you prefer dividend stocks or index funds? I read every comment. Don't forget to subscribe to Build a Millionaire for more no-fluff investing breakdowns. Thanks for watching. I'll see you in the next one.